US microcap investor, becomes more international and focused. In the mid kind of 2010s, 2012, 13, 14, and we saw it a microcap club too, is you started to see a lot of US investors look north of the border into Canada, because again, they have similar accounting rules. They're just north of us. Their filings are in English, and it's a kind of an easy leap to make. And so starting like the mid 2010s, you saw a lot of US investors, including myself, start looking at Canada. And especially at that point in time in Canada, it's mainly a resource centered focus for their investment base. There was a complete just lack of interest in non-resource small companies up there. And so you could find, companies growing 30, 40% a year, profitable, trading at single digit PE multiples. And so there was probably a 2 or 3 year window where you just had a flood of US investors kind of going after those non-resource companies. And then you saw that ARB gap close. As all of a sudden, all right, after 3 or 4 years, they're kind of trading the same level as the US microcaps. Then after that, you kind of saw a movement to Australia or Europe. And that's primarily my focus too. It's like, I now look at my sandbox of investment is not just the US, but it's Canada, it's Australia, it's Europe, because mainly in those other areas outside the US, they still have real businesses going public that are small. They still have $10 million IPOs of a company that's growing and profitable, that goes public. And so that's the reason why it's important to be global. The biggest winners, some of the most explosive in a positive way situations were kind of these lightning in a bottle stocks. And they had kind of 3 primary components. Number one, they started when they were small, and so they were microcaps. Many of them were sub 100 million market caps. And the reason for that is, small, great businesses, there's a discovery process. First, retail investors discover the company first because they're the only ones that have a small enough amount of capital that can acquire the shares because these companies are so illiquid. So it's retail, it's smart retail finds them first, then institutions find them second, and then dumb retail buys them third, on the back end of it. And when you're looking at a sub $100 million company, you're in that first part of the discovery process of the great company. And so that's why being small matters. The second part of that was a business with a high organic growth rate and or high operating leverage with the business. And the reason why that's important is pretty much anybody and everybody, including institutions, are attracted to high organic growth rates. But it's also important that they're not cash burning companies. You got to find them that are profitable and or very close to profitability. But the reason I like high organic growth rates as well is, if you're buying them at a reasonable price, your forward return should probably match the organic growth rate of the company, even if the multiple stays consistent over time. And so, you have this unique business with a high organic growth rate. And then what I kind of like the jar part of it or the bottle part of it is having few shares outstanding. The outstanding share count of the company kind of less than 20 million, preferably less than 10 million. And I'm a big fan of scarcity. And the reason why a company with a low outstanding share count is so attractive is just there's not very many shares available for anybody to even acquire, the business. And so when somebody goes to buy the shares, they have nowhere to go but up. And it's kind of similar to, I used kind of the comparison to Pablo Picasso. Pablo Picasso produced, I think, 1,900 original paintings during his lifetime, and today he's probably the most famous artist like on the planet. And most of his paintings are owned by private art collectors and also museums. And only probably 1 or 2 or 3 come up for sale every year. And those 1 or 2 or 3 go for tens of millions of dollars to over $100 million in value. And that's because of scarcity. There's just a lack of supply and unlimited demand. And that's the same thing with an illiquid stock, a company with few shares outstanding. And even if you want to take scarcity to another level, great businesses in general, whether it's large cap or micro cap, great businesses trade at a premium because there's a scarcity value of them. There's not many of them that exist, and that's why they trade where they do. And so that's also an element of scarcity that I find attractive. So when you combine all 3 of those things, small company, unique one of one business that has a high organic growth rate or a high operating leveraged business, combined with just not very many shares outstanding, it creates very explosive kind of earnings per share growth. And that's what I've seen over 20 years is it's those companies that can go from zero earnings per share to $1 to $2 per share earnings per share in like 1 or 2 years that just captivates, that mesmerizes the investor base. And institutions are just drawn to them like a moth to a flame. And that's where you get 10 baggers, 20 baggers in a couple of years is from those situations. And so what I primarily have found is that when it comes to finding companies, it's predominantly three ways, and then there's kind of a fourth kind of umbrella way of doing it, so it's kind of brute force, screening, networking, and then kind of this umbrella term would be curiosity, because I don't think you can do any of those three without a certain level of curiosity, wanting to find the truth and wanting to find something. But the first way is brute force. And kind of the key with brute force is the only way you aren't missing something is to look at everything. And, Michael Liu and I recently did this in the UK on the London AIM Exchange, which is sort of like their smaller NASDAQ version in London. And we literally went through 1,000 public microcaps on the London Exchange, A through Z, and we actually try to do this every other year on the OTC markets here in the US, literally go A through Z through the entire list, because that's the only way you don't miss anything. And I also know other investors that literally look at every single press release of every company under a certain market cap. It's the way they kind of spot something changing or something that could be actionable. You also see a lot of different ways that people just kind of use this brute force, and it sounds tedious, but it's all about trying to find those crumb pieces of what could be a promising investment, basically. The advantage of brute force is that few others are going to go through that effort. Just me saying this, people probably start to fall asleep thinking about going through 1,000 companies. When you're going through it, a lot of times you can takes 10 seconds sometimes, to go through it. And what you're doing is you're kind of going through that quick overview, those 10-second ones, check them off or cross them out, I should say. Then anything that looks half interesting, you kind of like highlight. And then you go back through, you take that 1,000 down to 70. And then the ones that are half interesting, you might spend 5 minutes on. Well, 80% of them go away. Now you're down to like 15. And then you might spend 15 minutes on those. And then, so it takes time, but it's not an inordinate amount of time. It sounds worse than it is. And especially as you kind of grow as an investor and you gain experience and what you're looking for, it's easier to say no to things. Yeah. So I think brute force, again, the pro is that you don't miss anything. The con is it's tedious. But I think that's also the advantage of brute force, is because you're able to look through, this mountain of uninvestable ideas is sort of an advantage, because few people will want to do that. The next one would be, that we talked about, was screening. And, there's a couple of different ways you can screen for companies. And all screening is doing is you're taking the investment universe, you're plugging in some either financial parameters or some other parameter, and you're trying to take that ocean of stocks down to a pond. That's kind of what screening is. And a lot of folks use more of a, I would say, targeted approach, using mainly specific financial parameters. But the problem with that is there's a bunch of other investors doing that exact same thing. And so you're all staring at the same list of, 30 companies, because everyone's going to put in, well, I'm looking for something that's growing 30%, that has 80% plus gross margins, that has 20% operating margins, that has debt to equity of this or ROI of that. You're staring at the same companies everybody else is. You're looking at a bunch of probably fairly valued to overvalued situations. I like to use more comprehensive screens. And Michael, who works with me at the funds that we manage, he does a great job of this. One of the screens that we do is for insider buys over a certain amount, and that's kind of globally. And the reason we like to do that is there's oftentimes, we mentioned before in this interview, here in the US, a lot of times it's an old situation where a new management team comes in, provides a capital infusion. And so that's triggering us to potential transformation is when you're screening for large insider purchases. If somebody's putting in a small microcap, $500,000 or more into a business, they obviously think that the stock's going to go up. And so it doesn't mean that it will, but it's enough for their spidey sense to go off that we should probably dive into this situation. And so that's predominantly the type of screens that we do, from that perspective. And then, networking, we kind of already hit on before, but that becomes less of an asset in the beginning of your maturity and then just keeps growing. And probably 10 years into your building out your investor network, it's by far the most important part of finding ideas is through that investor network.
I just wanted to jump in here and tell you about this new valuable resource that we created for you. The biggest challenge to taking control of your personal finances, improving your investment returns, and building a better future is just getting started. This means getting organized, having a plan, and being disciplined. As Mark Twain once said, the secret to getting ahead is getting started. If you're not satisfied with where you're at financially, whether that be not having enough savings at the end of each month, watching your cash being eroded away by inflation, or maybe you're not sure where to get started with investing. Down in the description below, we put together a free guide for you called The 4 Simple Steps to Take Control of Your Personal Finances and Life. You can get this free guide by clicking the link in the description below.
When it comes to analyzing, probably the first thing I do is look for red flags, which are important. You're trying to get to quick no's really quickly because half of all public companies are microcaps, so there's not a lack of ideas. So you just want to get to a quick no. And so kind of the most prominent red flags for us as investors is, past associations with fraud, is number one. It's amazing how many investors and how many institutional investors don't put each management's name into Google with the word fraud and see what comes up. It's just simple stuff like that, which sounds insane. You're like, oh, of course I would do that. It's amazing how people just don't do that. I mean, that's like number one. Number two is, a small time auditor. So the company has an auditor that audits the financials, that basically blesses the financials, and you look into it and you realize they only audit one other public company. It's also based out of Nevada or or Boca Raton, Florida, or something like that. No offense to Boca Raton. The third thing is just a messy capital structure, just a lot of shares outstanding, kind of the opposite of what I was saying when we were talking about lightning in a bottle. A lot of shares outstanding, different classes of shares, lots of warrants. You see a lot of self-dealing from the management, repricing their options or whatever the case may be. That's a red flag. And then also another prominent one is just a lot of related party transactions, where the management team is figuring out ways how to enrich themselves with self-dealing, whether it's, sale leasebacks with the company headquarters, or, we've even seen it quite a few times where, the personal plane is paid for by the company that they use specifically for personal, business mainly, just stuff like that. It's just red flags. And also it's one of the things that becomes less and less attractive as a quality focused investor are those companies that have like large investor relations campaigns, to really promote their stock in different ways. And so those are kind of the red flags that we first do when we analyze microcap companies. Is you're trying to get to a quick no right away. I don't think microcap investing is too much different than other investment classes where you have thousands of options to put your capital. Mm-hmm. It sounds like a Yogi Berra quote, but to find something, you first need to know what you're looking for, and you need to know who you are. When you start out, you really don't know. When you start out as an investor, you really don't know what you're even looking for. You approach things as a sponge. Then over time, as you experience things, you soak up everything and you learn from reading and experience. And slowly but surely, you turn into a filter. You start filtering things out. And I actually started writing an article that I'll probably put out at some point this year, on this topic of active patience. And I mentioned in an article a few years ago that I wrote. And, I think if I were to define active patience, it's knowing what you were looking for and not doing anything until you find it or it finds you. And I think you develop kind of active patience and the ability to find things quickly, through this development of three steps. You first have to develop your temperament as an investor, which means determining what flavor of investing aligns with your kind of natural inclinations so you can apply consistently and successfully over time. That's your temperament. Investing's greatest lessons can't be taught in a book or a classroom. They have to be experienced. So it just takes time to develop that temperament. And the temperament is, your views on risk, your time horizons, your position sizing, and all of those kind of, I don't know, broad pillars of investing. Then you have to develop your principles over top of that. Once you figure out kind of what type of investor you are, it's really the principles of what guides you. It took me 15 years to develop kind of my theories around those four attributes you mentioned earlier about growing through a recession, a balance sheet that can endure. I'm looking for intelligent fanatics. I'm looking for a valuation that can hopefully double in 3 years, things like that. It took me 15 years to kind of develop that around scarcity, survival, tailwinds, discovery. That didn't happen overnight. It took 15 years of investing with different types of management teams and CEOs, speaking to them, having dinner with them, truly knowing them, until I started to see patterns in kind of their personality and character, that these are the types of people that I would align with, and so it just takes time. And when you do all of those things, when you know what your temperament is, when you know what your principles are, then you just need to apply those things consistently with commitment. And, just be fully committed to those, because anything less, it's just, you're not going to be able to see it through to the end. That's why I don't get too hung up over a missed opportunity that I missed, because it probably wasn't something that I would have been able to hold anyway if it went up. So that's how you develop kind of this active patience. And when you do that over time, you can get really, really quick at saying no to an idea. And you can get really, really quick at saying yes too. There's been times where I can get to a yes in a few days, because it just, I'm not talking about, I have to do 6 months of work into a name and produce 200 pages of notes. Like, the best ideas, they kind of hit you or punch you in the face sometimes. And those are the great ones, because that means they were meant for you,
I certainly kind of agree with you. It wouldn't be surprising to see them come downstream into microcap, because more and more of these companies are actually uplisting in the New York Stock Exchange. A lot of them here in the United States, I would say probably over 50% of microcaps trade on the OTC markets. And so a lot of those Reddit crowd, they won't participate in anything that's OTC markets, but they would if it's trade on the NASDAQ or New York Stock Exchange. So I think, it wouldn't be surprising to see that activity pick up. We certainly see a little bit of it, but not to the extent that we saw in GameStop or AMC or things like that.